Today is January 17th, 2025. I wanted to make this video as a record for my business valuations for myself. And if it interests anybody else, all the better. The uh, the first stock I'll talk about is a liquidation value stock. The formula I use for these stocks is directly taken from Benjamin Graham and David Dodd's security analysis. The liquidation formula and margin of safety from the book. I focus on nano cap businesses under a $50 million market cap. The business's name is Everybody Loves Language Corp. Stock ticker ELL. It's on the TSX Venture Exchange. This business provides digital and paper language learning for customers, primarily in China and secondarily in South America. This business's liquidation value is 1.9 million. For the margin of safety requirement, take the market cap and divide it by the liquidation value. We're looking for an answer below 0.67. This business qualifies as buy. However, this business is partnered with another business, creating a new corporate entity and giving the partnered business partial share of ownership. Everybody Loves Language Corp has not disclosed how much equity they're going to give up. And so because of this, we need to purchase the business at a share price of 0.03 or less in order to be safe from loss of equity. The hold period for this business is 2 to 3 years, or anytime you take the market cap and divide it by the previously mentioned liquidation value. And this answer is 1.0 or higher. And this is the intrinsic value of the business once it reaches 1.0. The next business we'll talk about is a cash flowing business, a cash flow value business. For these, I focus on businesses under 2 billion in market cap. The name of the business is Dorian LPG, ticker LPG on the New York Stock Exchange. I use Warren Buffett and Charlie Munger's adaptation of Benjamin Graham's investment strategy. For this, I use a discounted cash flow calculation to project cash flow into the next 10 years. Some of the things I use for this formula is the discount rate being the 10-year treasury rate. Growth rate is the year over year of the business's earnings over the last 5 years, averaged with the industry average year over year growth rate for the last 10 years. For earnings, the average yearly earnings for the last 5 years plus amortization for the most current year, plus or minus change in working capital. For earnings, I take into account salaries for employee layoffs in case a business is trying to increase earnings in the short term to hide a decline. The term I set is 10 years for this calculation. The margin of safety percentage I use is based on a formula I use to compare earnings to liabilities. In this case, I reduce my discounted cash flow answer heavily by 55%. The amount of cash this business will produce in 10 years after using the margin of safety is $5.7 billion. And taking this number and dividing it by the market cap, we get a 531% return by 2035. This business is a marine oil tanking shipping company, shipping liquefied petroleum gas. Simply, this business this product is similar to the propane that you use in your barbecue. It can be used for heating, small scale electric generators, and it is also used as a feedstock for making petroleum-based products. It is a volatile, unloved petroleum industry. This niche industry is actually growing over time. Its biggest competitor is BWLP, which is also a great business, but they have slightly bigger ships and slightly older fleet. BWLP mainly focuses on paying out as much of their earnings in dividends as possible, but Dorian LPG focuses on a mix of dividends and share buybacks. My preferred business is Dorian LPG because the smaller ship size allows them to have a more flexible customer base with medium and large deliveries, while BWLP can only do large deliveries. Additionally, share buybacks are a more tax efficient way to return equity to the shareholders, especially if you're a shareholder based outside of the US. These LPG ships can also easily be converted into ships with the ability to carry ammonia. Overall, a very volatile industry with the biggest actual long-term risk being global regulation of petroleum itself and also the carbon efficiency of the marine tanker ships. But over the long term, even with the future cash flow reduced by 55% for our margin of safety, I see this business as one that will do very well and is highly undervalued. Um, so these are the two value opportunities I currently see available. I may upload more in the future with more value opportunities, or I may make an update video to see how these valuations play out in the future. Take care.